Everyone, thank you for joining us for our live webinar on Introduction to Forex Trading on Phillip MetaTrader 5. This is Lucas. I'm a Business Development Executive with Phillip Nova. During the webinar, if you have any questions, do type them into the question box and we'll try to address them during the Q&A session at the end of the webinar. Allow me to introduce our speaker, Mr. Jun Kit, who is a strategist at Phillip Nova. His main area of expertise is in Forex, with a major focus on major pairs. As part of the Forex or Bullion desk, Jun Kit specializes in the business development of products and platforms to support the trading needs of customers. He is also actively involved in engaging the trading community by regularly organizing campaigns and events. His market views and comments have been regularly published in the Business Times, 联合早报, Money FM, and the Phillip Nova website. Let me invite our speaker, Mr. Jun Kit. Jun Kit, over to you.
Hi, thank you, Lucas, very much for the introduction, and a very good evening to ladies and gentlemen. Once again, my name is Jun Kit from Phillip Nova, and thank you so much for joining us here tonight. Okay, so I will go ahead and start sharing my screen. Okay, so once again, the purpose of this today's webinar is really, to give you an introduction to the world of forex trading. So we hope to equip some of you. You may be complete beginners, but that's okay. We're gonna go from the absolute basic knowledge to somewhere that give you some idea on how you can actually start placing a trade. Okay, and before we proceed further, I'd like to make a disclaimer first that whatever that will be gone throughout this session is only for educational purposes only, and it does not, it shouldn't be taken as any financial advice, because it does not take into consideration your personal investment objectives, your financial situation, as well as your personal risk appetite. So just be aware that it is only for educational purposes only. Okay. So then we can proceed on going through the outline for today's sharing session. First, I will do an introduction to Forex, and then also to go through some of the popular terminologies and mechanics in Forex trading that you need to know to get started. Okay, and thirdly, I'm also gonna briefly go through an introduction to CFD that you can also trade on this platform that we're gonna share about today. Okay, and then also to set some context, if you want to start forex trading, you need to know an overview of what is fundamental analysis and what is technical analysis, and I'll just give you a brief walkthrough on that to give you a bit of idea. Okay, and then fifth, we're gonna go through the Phillip MT5 trading platform, where I'll demonstrate to you what is happening in the platform and how you can navigate around and to ultimately place a trade. And number six, would also like to introduce you. This is a new feature on this trading platform, which would allow you to follow trade signals that are from credible sources, and you'd be able to follow this trade signals and place a trade with just a button. Okay, so that is that. And lastly, I'd like to encourage you to stay towards the end, because at the end of this webinar, we have an exciting exclusive perk extended just for you, those who are attending this webinar live. Okay, so I think I've given the context of today's webinar, and let's dig in. So firstly, introduction to Forex. For those people, you may have heard of Forex, but you don't quite know what it is. Basically, it is also known as the foreign exchange, or the FX market. It is actually a global marketplace where various national currencies are traded. Forex is also defined as the giving of one currency in exchange for another at an agreed rate by both parties. Okay, and Forex market, interestingly, is actually the largest and the most liquid market in the world, with trillions of dollars changing hands every day. Okay, and also, according to a study done by a central bank survey back in 2019, the daily volume of the Forex market is actually as high as $6.6 trillion. Okay, so this is actually way higher than the stock market that you may be familiar of, or even the cryptocurrency market. So foreign exchange market is really the largest and the most liquid market in the world. And the main players of this market, it includes multinational corporations, institutional investors, governments, and also retail investors, just like you and I. Okay, and Forex market, unlike the stock market, it operates 24 hours a day, 5 days a week. And Forex is normally also traded on leverage. Okay, so to understand, I think at this point, some of you may be wondering, why is it possible, that the market can operate 24 hours a day, 5 days a week without rest, unlike the stock market, there is an opening time and there's a closing time. It is based on this concept called over the counter. So before we go further, I'd just like to, clarify this differentiation between something that is exchange traded versus something that is over the counter. Okay, so exchange traded, I think it is very well illustrated with this graphic over here. So you can see that everything is centralized, pointing to one point. So in this case, we would refer it as something that is traded on exchange, so in a central location. And the second one being over the counter, as you can see from the graphic, it actually it connects from many various part. Okay, so it does not get restricted into only a central location. So what is exchange traded? These are things like stocks, futures, where people go to a central location, like for stocks, people go to SGX, they go to Nasdaq, they go to New York Stock Exchange, a centralized location to trade stocks. I mean, same goes to futures. They also go to a futures exchanges to trade stocks. So you can only trade something that is exchange traded when the market is open, and everyone will come to this central location. Okay, so over the counter, which is what Forex is based on, it does not have a physical location or a central exchange, and essentially it is spread across the world. So just think about it. If you're planning to have an overseas trip sometime soon, and you head down to town to the money changer, and you like to change some SGD for some foreign currency, so effectively at that point you are already participating in the foreign exchange market. And also to also explain why the market is so big, just look around you, like for everything that you buy, the food that you eat, the electronics that you buy, so likely these are the things that they're manufactured overseas. So whenever there's like cross-border transactions on exchange of goods, there has to be an exchange of different currencies. Okay, and then it's also interesting to point out that most transactions done on the forex market is based on speculation. Okay, so also to explain how we are able to operate 5 days a week and 24 hours a day is by something called the trading session. Okay, because normally this trading session, they will start from Sydney, because Sydney is the earliest city to start any day. So once the Sydney session is open, then we will come to the Tokyo session, which is more the Asian region. Okay, so subsequently we will move over to the London session, and ultimately we will end the trading day with New York session. Okay, so from Sydney to Tokyo to London, there will be overlap, like 2-3 hours into the Sydney opening, then the Tokyo would open. Okay, so subsequently it happens like this, and at the end of the New York session, so the New York session will end, and then the Sydney session will step in to start a new trading day lah. So this is the reason why forex market is a market that never sleeps. It basically keeps operating throughout the week lah, except for weekends and public holidays. And also one of the great things about this is that you don't have to be restricted to the opening and the trading hours of, let's say you want to trade US stocks, you have to wait for the US market open to trade. So anyone is able to trade the forex market at any time that that the schedule allows. So I think that is one of the good things that people prefer to trade forex. And then to put things into a more visible way, so this is a timetable. So it shows you the starting time of the Sydney session is around 5 a.m. Singapore time. So like also at 8 a.m. the Tokyo session will kick in, and then at 3 p.m. the London session will kick in. So the New York session will only start at 8 p.m. at night, goes all the way till 5 a.m. the next morning, and that is when the Sydney session starts again. Okay, and if you see here, I've circled up this time slot over here. So in case you haven't already guessed it, so from 8 p.m. to 12 a.m., this is actually the best time for you to trade. Okay, and there are a few good reasons as to why this is so. Okay, so this is because the Euro USD is the most popularly traded currency pair. Okay, so London also essentially representing the Euro. Okay, and New York, it represents US. Okay, so these two regions are actually the largest economic regions in the world, and therefore their currencies are also most popularly traded. Okay, so from here, we would be able to enjoy high volatility as 70% of all trades happen during this time. Okay, and also the forex market is highly influenced by the US dollar. And then whenever there is some economic events or there are some announcements that happen from US, it tend to be during our Singapore nighttime, where the news, the inflation report gets announced, or the monetary policy gets announced. So that is when it will stir the most volatility in the forex market. Okay, so what are some of the reasons that forex trading is so popular? The first reason, it is the volatility. Okay, so the higher the volatility, actually the higher the chance of you making a profit or loss from trading a currencies. So imagine you're buying into something that the price barely even move. So essentially there won't be any incentive for you to start trading the product, because price don't move. So there is a very little chance for you to make money out of the price movement. So forex market is good in the sense that it has very high volatility. Okay, and also you are able to trade on leverage in forex market. Leverage allows you to open a large position with just a small amount of capital. Yeah, in Singapore, forex is traded on margin from 5%. So essentially you are able to leverage your capital by 20 times. Okay, so leverage also allows you to make high profits with just a minimum amount of capital. And then thirdly, you are able to go bi-directional with forex trading. It allows you the flexibility to trade in both directions to profit from the ups and down in the market. So let's say today, Euro USD, this currency pair, you can either buy this currency pair, or you can either sell this currency pair if you think that the currency pair is going down. So forex trading offers you this kind of flexibility. And lastly, it is also good that you can enjoy high liquidity, in the sense that you are able to buy and sell anytime during the market. Okay, so next up, I would move on to some of the terminologies and mechanics in forex trading. So I think for someone who's totally new, I think there are a lot of terminologies that you just can't wrap your head around. So in this segment, we aim to keep it as simple as we can to present it in a meaningful manner. So currencies, they are normally quoted in a 6-digit, 6 alphabet. Okay, so the first 3 alphabet is called the base currency. And the last 3 alphabet, it is called the quote currency. Okay, so it is always quoted as a pair. You never see people quoting a currency as a standalone currency. Okay, because this has to be the base currency is priced relative to the quote currency price. So therefore, it is always a currency pair. So when you buy a currency pair or you long a currency pair, you are essentially buying the base currency and selling the quote currency at the same time. So the rationale behind this movement is that you are hoping for the base currency, in this case the euro, to appreciate against the quote currency. Okay, so in the opposite end, if you are selling this currency pair or you're shorting this currency pair, you are actually selling the base currency and buying the quote currency. Okay, so you are hoping for the base currency to depreciate against the quote currency in this case. Okay, so it is very important for us to distinguish between the base currency and the quote currency. So next up, let's look at some of the most traded currency in the world. So the first one, I think you probably could have guessed it, it is the US dollar. Okay, and then secondly, it is the euro. Thirdly, the Japanese yen. Fourth, the British pound. Australian dollars, Swiss franc, Canadian dollar, and New Zealand dollar. So these are 8 of the most popularly traded currencies in the world. Okay, and if you would just want to narrow down to how currency pairs are categorized, so there are a few main categories. The first being the majors, the second being the minors, and then we also have something called the exotics. Okay, so majors, minors, exotics, you will hear forex traders talk about this all the time. And I also like to highlight under majors, there is something called the commodity pairs. Okay, so what are the currency pairs that fall under each of these categories? Let's take a look. So under majors, you have the Euro USD, USD JPY, GBP USD, and USD CHF, which is the Swiss franc. Okay, so under the commodity pairs, you have the AUD USD, which is Australian dollars, the US dollar versus the Canadian dollars, and lastly, we have the New Zealand dollars versus the US dollars. Okay, so at this point, I just like to highlight again that commodity pairs actually, they are part of the majors also, just that they further categorize this under commodity pairs because these three currencies, the Australian dollars, the Canadian dollars, as well as the New Zealand dollars, these are currencies of countries who rely heavily on the commodities trade. So any movement in the commodities would likely stir some volatility in these currency pairs. Okay, and also now you may be asking, like, why would these currencies be called the majors? So if you take a minute or two to carefully scrutinize, you'd be able to find a similarity that they all have US dollar in a pair. Okay, and on top of that, what makes a major pair is pairing the 7 of the top traded currency pairs that I covered in the earlier slide with the US dollar. You get the major pair. Okay, so just now I mentioned things like the euro, the Japanese yen, the British pound, the Swiss franc. So these are all the most popularly traded currency pairs. So pairing these currencies versus the US dollars, you would get a major pair. Okay, and moving on to the minors. So minors actually comprise of the mix and match between all the top traded currencies except US dollars. So essentially, looking at the previous slide, you'll be taking all this currency minus the US dollar, and then you mix and match them together. They will be called the minors, or some people like to call it the crosses. Okay, so that is the minors. So moving on to exotics. So exotics are currency pairs that consist of currencies from smaller economies, like Hong Kong, Singapore, or Thailand. So these are relatively smaller economies. So they are not that popularly traded as compared to the major countries. Therefore, their currencies would be more prominent in the global Forex market. Okay, so at this point, just like to let you know that the major pairs are actually the most popular pairs that someone who's looking to start trading forex, they would first look at the major pairs. So this is also supported by a few reasons. So firstly, there is a high volume of these currencies that are traded. Okay, and what this means also that for someone who's just starting to learn about forex trading, you are able to gain a lot of analysis and news on this currency pairs during your research. Okay, so because for most of us when we're just starting out, we tend to look for a lot of analysis done by banks or brokerage houses or technical analysis in order to help formulate our judgment for our own analysis in the future. So these would be the best place to start, as you would get ample of that information online for your learning. And also secondly, there is very high liquidity in this market. So what is the benefit of having a high liquidity? It results in a narrower spread, and so as compared to the exotics who are less traded, these spreads or these pairs would be more competitive. They would be smaller. Okay, and also there's always someone to buy and sell at any given time for these currency pairs. Okay, so moving on, I'd like to show you this screenshot. So I'd also like to share with you how to read this quote. So normally when you go to a money changer, you'll be able to see that buy and sell, there are two sides. So in forex trading, we normally call them the bid and ask price. Okay, so for now, let's not look at the buy and sell during this at the screenshot. Okay, so let's just focus on the bid versus the ask. So bid is the price that you as a forex trader actually sell the currency pair. Okay, so bid is the price where you sell the currency pair, and the ask is where the forex trader you buy the currency pair. Okay, so for those people who are not on MT5, because I would just want to say that MT5 in this screenshot, they've made it very easy for you to understand. So you know that when you want to buy this currency pair, you look at the buy price. But in the industry norm, we normally call it a bid and ask price lah. Okay, so if you're looking to buy a currency pair, let's say Euro USD on MT5 platform, you would refer to the price on the right side, which is the buy price. So after that, when you want to sell the position, you'll be looking at the sell side, which is on the left side, for the price that you'll be selling at. Okay, and another term that people always talk about, it is pips. So pips, what it means is simply the fourth decimal figure on the quote. Okay, because the forex market, they don't move by cents. The movement is very minute. So we have to narrow down to the fourth decimal place. Okay, so it is what we call the pips. And also, if you want to narrow down further to the fifth decimal number, it is called the pipette or the fractional pips. Okay, so next up, we are going to talk about what is spread. Okay, so spread is simply by taking the ask price on the right minus the sell price on the left. Okay, so if you look at it, if you just take the ask price minus the bid price, you would get 0.6 pips. So what is spread? It essentially is a cost of you trading Forex, because Forex trading these days, it is mostly zero commission. So the only way or one of the two costs that you would incur during Forex trading is by incurring this spread, okay, which is the difference between the ask price and the bid price. And on Phillip MT5, actually, it is pretty competitive lah. The spread is really as narrow as 0.6 pips. Okay, and next up, I'd like to talk about lot sizes. So if you want to trade Forex, it doesn't just go by any random amount that you like. They are normally traded at specific amounts called lots. And it is the number of base currency that you would be buying or selling. Okay, so there are three lot sizes. The first is a standard lot, which is 100,000. Okay, if you want to trade a smaller size, you can trade a mini lot, which is 0.1 of a standard lot. So it has a notional amount of $10,000. If you're starting out small, you can always start with a micro lot, which just has a notional value of $1,000. Okay, so on the right side here, this is a screenshot of the order ticket on MT5. So I think in actual practice, when you're looking to trade, you don't really have to remember like a one lot is equals to 100,000. Of course, it's useful that you are aware of this, but when you are placing a trade in MT5, you just type in a 0.1 or 1 or 0.01. It will tell you how much of the base currency that you are trading here. So you see this is 0.1. So it is a mini lot of the base currency. Okay, so in this case, the base currency is euro. So you are buying a $10,000 of euro with the USD. Okay, so that is the lot sizes. So next up, I also like to share some of the Forex trading mechanics. So we aim to answer these three questions to clear up some of the confusion that you may have. So firstly is how money is made on a Forex trade, a simple illustration. Secondly, how much money do you actually need to start trading Forex? People normally say, sometimes people say that, oh, to trade Forex, you need to have a lot of money. So is that really the case? We'll find out. And thirdly, we will go through some of the cost of trading Forex. How is money made on Forex? So a very simple illustration. So let's say today you purchase a mini lot of Euro USD. So that's a notional amount of $10,000 at this exchange rate at 1.18. So the cash flow looks something like this. So you're buying $10,000 of Euro with 11,800 of USD. Okay, so you buy this currency pair, you're receiving this euro, the base currency, and then you are buying this with the quote currency, which in this case it is the US dollar. Okay, and 2 weeks later, you would exchange your position. You would sell this position essentially at the rate of 1.25. So you see the rate here has really increased from 1.18 to 1.25. So if you sell it at this time, the cash flow will look something like this. You are giving out $10,000 euro, but you are receiving 12,500 USD in return. Okay, so just by this operation, you say you are earning a profit of $700. So this is just a very simple illustration of how P&L is calculated on the Forex. Okay, so how much money you actually need to start trading Forex? So to answer this question, we need to know what is margin. So margin is actually the amount you would have to deposit to take up trading position. Okay, and it is actually usually a fraction of the underlying asset value. And the purpose of this margin is to help ensure that both parties, fulfill the obligations. So actually both buyers and sellers also must put up margin payments when they are placing a trade. Okay, so in Singapore, Forex is traded on a 5% margin. So let's look at for each size, how much margin you have to incur to place a trade. So for a standard lot at $100,000, you take that times 5%, you would only have to fork out $5,000, to initiate a position that is as large as $100,000. Okay, so for mini lot, you would only need $500 to start a mini lot position, and then also in a micro lot, you only need as little as $50 to initiate a trade in Forex. Okay, so I think this should be quite an eye-opening figure that some of you may see, because people normally believe that to start trading Forex you need a lot of money, but the truth is most of us, we start with a small amount, and then we slowly build our expertise and skill, then we start trading bigger, and our account start growing bigger. Okay, so leveraging with margin, essentially it leverages, it magnifies the amount that you put in, so that you're able to control a much larger position. Okay, so also you should be aware that a small price movement can result in larger profit and loss. So it goes both ways. It magnifies your profits, it also magnifies your losses at the same time. So it is actually a double-edged sword, forex trading. So at this point, I also highlight that on top of all that you have to, on top of all that you would learn in this session, it is also important, to further your learnings, because I think honestly, 1 hour, it is not sufficient for you to build enough knowledge to start trading. We try our best to equip you with some of the fundamental basic knowledge, but you would have to go on further to explore yourself on things like risk management, because risk management is really the absolute most important thing in forex trading. So without risk management, you would really enjoy, you really suffer the magnitude of losses as high as the magnitude of profit that you can potentially gain. So risk management would help you limit your losses while exposing yourself for that high gains. Okay, so just a note that you should be aware of. Okay, so next up, cost of trading forex. So the one of the costs that you would incur during the forex trading is something called the spread, which I covered earlier. Second, it is something called the swap. So this swap is not to be confused with that derivative that some of you may be aware of. This swap is actually really just a rollover interest rate, which is the net interest rate that is accumulated on a position if you hold it overnight. Okay, so to put it more simply, swap is simply just the financing cost that you have to incur in order to hold that position overnight lah. Okay, so remember, we talk about margin, you're only outlaying 5% of the entire contract value. So for the remaining 90% of money, you are actually borrowing them. Okay, so what happens when you borrow money? You would have to incur financing cost on that. So essentially that is what swap is lah. Okay, so just a simple illustration here. Suppose you long Euro USD. So you're borrowing US dollar to buy Euro. Okay, so here you would incur borrowing costs on the US dollar, and you would receive interest rates on holding Euro. Okay, it makes sense, right? You're borrowing something, so you incur the borrowing costs. So while you're holding something, you would receive the interest rates of that asset. So swap is also the difference, between the two different interest rates in that transaction. So in the event of a positive swap, you are actually gaining the interest rates differential. And in the event of a negative swap, you are actually incurring costs on your trade lah. Okay, so but most of the cases, you ought to be incurring financing costs on your forex trade when you carry it forward to the next trading day. Okay, so that is the introduction to forex trading. So next, I like to touch up upon CFD. Okay, which is also tradable on the platform that we will go through shortly. So CFD, it is actually a short form of contract for difference. It is a derivative, so which means that it's an instrument where prices are derived from an underlying asset. Okay, Okay, so what it means, or what CFD essentially is, it is an agreement between two parties to settle the difference between the opening and the closing price of their contract. Okay, so just let's say take the example of share CFD. So let's say you're entering into a contract of share CFD, Apple share CFD. You don't actually own the underlying share, which is a Apple share. You don't own an Apple share. You are simply entering into a contract with a broker to exchange the price difference. You know, when you buy and when you sell, you are simply exchanging the price difference, and there is totally no ownership of the underlying asset at all. So there won't be any physical delivery of the underlying. You're just trading the price. Okay, similar to Forex, this is also a leverage product. Okay, so what CFD allows you to do is that it allows you to participate in the price movement of that asset without actually owning the underlying asset. Okay, it takes reference from the prices quoted in the underlying exchange, and therefore it is only available when the relevant market is open. Okay, so unlike futures, there will be no expiry date, and you can hold on to the position as long as you like, and it is cash settled. So some of the CFDs that you are able to trade, there are things like global indices CFD, like S&P 500 indices, Nikkei 225 indices, among the many examples. Also share CFD, ETF CFD, energy CFD, like the crude oil, the Brent crude oil, commodities, and also there are other kind of assets that you are able to trade under CFD. Okay, so why would people actually trade CFD? Actually, there are a few reasons. Firstly, it is because it has very small barrier to entry. So, you know, for some of the CFD contracts, you could really just trade from as small as one share, and be, you know, a penny stock, a $1, $2 share. You can really just trade that one share alone in CFD. So it is very accessible to most of us. Okay. And secondly, you are able to trade both bull and bear markets. So let's say in a stock market, you know, you can only if you buy a stock, you are hoping for it to appreciate. So in CFD, you are able to buy the CFD contract if you hope that it will go up, and you can also sell the contract when you believe that it is going down. So you are able to go bi-directional with your trade. So essentially, no matter the market is going down or going up, as long as there is a volatility, there is a chance to make a profit through CFD. Okay, and thirdly, there is no expiration date or risk of delivery. Fourth, it is also traded on zero commission, so you wouldn't incur any commission on your trades. And fifth is the capital efficiency. So this brings back to the point on margin trading, where you're able to control a large position using a small amount of capital. Okay, and number six, it is the hedge position feature that you're able to, you know, take advantage of with CFD. So let's say, for an example, today you are holding shares A. Okay, this shares A, you believe that it is going to go up very high in its long-term perspective prospect. It is going to go very high, and you have the long-term view on that. But in the short term, it is suffering some volatility, some challenges that may cause it to come down. So what you want to do here is that you do not wish to liquidate your actual holding of the shares, because you believe that it's going to go up in the future. But in the meantime, you can come to trade CFD, you know, to short the market or to short a particular stock. So in this way, you are able to ride the downside move of that contract, and also not losing or not liquidating your actual position in that underlying share. Okay, so that is also one of the stronger proposition of CFD trading. Okay, so that is I've concluded the introduction for Forex and also introduction to CFD. So the next portion here aims to shed some light on what are the things that, you know, should go through a trader's mind before they place a trade. So normally they would do two things. It's called the fundamental analysis and also the technical analysis. So whenever you place a trade, there has to be a basis on which your trade call is done based on. Okay, so firstly, fundamental analysis. Basically, it shapes your trading decisions based on macroeconomic factors that will affect the supply and demand of the currency. Okay, so from here, I am focusing more on the Forex market trading portion. Okay, so basically you're looking at things that are happening around the world, that would affect the supply and demand. And these factors, they could be GDP, inflation, employment, interest rates, COVID-19 situation, the Russian-Ukrainian war. So actually all these events would have an impact on the currencies. So that is what fundamental analysis actually is. You look at the real world happenings and make a call on where do you think the currency would be going. So just a few examples of how certain economic events can affect certain currencies. So on the leftmost column here, we can see things like gross domestic product. And how people perform this kind of analysis is that they would take a look at the recent economic data, the latest released data, and compare against the expected data. Okay, so normally when the actual data comes up better than the expected data, it tend to be a good news for the market or for the currency that you're looking at. So firstly, let's say the gross domestic product. So this gross domestic product, GDP, inflation, employment. So these are the things that measures the health of an economy. So generally, when the economy is doing good, it tends to benefit the currency as well, because business would be booming, money would be flowing into the country for investments in that country. So therefore, it boosts up the demand for the currency and, also boosting the price of the currency. Okay, so opposite in the event that, the GDP that's released, it is underwhelming. It is the GDP or the economy of the country is performing worse than what the market believe or expect it to be. So at times like this, it would be detrimental to the currency pair lah. It tend to have have a negative reaction to it. Okay, so these are some of the examples here. Of course, the list goes on here. But for today's presentation purpose, I will not be going through all of the fundamental details. So basically, to wrap up this segment, fundamental analysis really just look at the real world economic indicators to shape your trading decisions. Okay, so that is fundamental analysis. Technical analysis, which I find is quite interesting, it helps you shape your trading decision based on price charts as main analysis tools. So you are able to understand the market sentiments based on historical price movements, and therefore you're able to forecast future price movements and determine entry and exit points. So actually, technical analysis, it is done based on a basis of belief that history will tend to repeat itself. Okay, so they look at the past price movement and bring it to the future price movement on the chart to try to project what is going to happen. Okay, so technical analysis is a whole news is a whole like a whole library or whole new segment of knowledge. But I just like to highlight to you a popular concept here called the support and resistance. So they are actually just psychological levels that buyers and sellers would act. So resistance is an imaginary ceiling that prices cannot go above. So whenever the prices reach this resistance level, the selling interest would arise and prices would start to decrease. So sorry for a typo here. So also to go through the explanation here, support is an imaginary floor that prices cannot go below. Okay, so the downtrend can be expected to pause due to the concentration of demand and buying interest. So when the price reaches a support level, the demand tend to increase due to the decreased price. Okay, so may I shift your attention to this graph, to this illustration here on the left. So let's just imagine this top line here is the resistance level, and this bottom line here is the support level. What you will notice here is that when prices move up to this level, there is a resistance, prices couldn't go up higher, and people will just start selling at this point, and it will come down here where people say that, oh, the price is really going low. They think that it shouldn't go lower, and therefore they will come in and buy, resulting the price to increase. Okay, so this is basically one of the important, foundation knowledge you need to know in your technical analysis. Okay, so there are two possible scenarios that can happen when prices reach the support or resistance level. So the first scenario that can happen is that the prices would bounce back from that support or resistance. So essentially it conforms to this level. So let's see here, the prices goes up here, it reaches this level, then it just bounces back down. So you see the market is thinking that the price is too high. They believe that this cannot be sustained. So therefore they sell. Prices come down here. People think that, the price shouldn't go any lower. Then they would come in and buy here. So it either conforms to this support and resistance, or it just breaks this support level and in search of the next support level. Okay, so basically technical analysis, when you look at chart for long enough, you realize that it is really all just human psychology, because prices, they are traded by humans, and humans emotion really do plays a direct impact on the charts they're looking at. So it's really interesting. Like technical analysis, you're really just studying the human psychology, or the human behavior in the form of charts. Okay, in technical analysis, people also look at chart patterns. You have the rising wedge pattern, where you see that you draw a resistance line, it's upward sloping, and then you draw a support line. If you combine these two lines together, you can see something resembling like a cone. So this is what we call a rising wedge. Okay, and people would normally project or predict that prices would break below this entry level and to reach down to this target level. Okay, so there are many types of chart patterns out there, rising wedge, falling wedge, also head and shoulders, or inverse head and shoulders. There's a long list of all these. Even if you just see all this often enough, you'd be able to draw them on your own on your chart. So it is actually pretty easy if you have go through enough of this. Okay, so the difference between fundamental analysis and technical analysis, it is actually fundamental analysis is for a longer term perspective, so because all these all these geopolitical events or the economic events, they tend to have a longer impact on that currency pair. Okay, so it would help you to determine the directional view, is it going up or going down in the longer term. So it helps you to answer the questions, what do you buy and why do you buy? So that is the fundamental analysis. On the technical analysis portion, it is mostly for shorter term to intermediate term. It helps you to identify entry point and it answers the question when. So, bringing back the concept of support and resistance, a support level tends to be a entry level, because, at this point, that the market wouldn't let it go further down, so you would enter a buy position, and therefore the market should rebound to go up. So that is how you use technical analysis to determine when you would enter into a trade. Okay, so the next portion, I'd like to share my screen on the trading platform, introducing you to the Phillip MT5 platform. Okay, so I believe right now I'm sharing my screen on the Phillip MT5 trading platform. Okay, so Phillip MT5 platform, you are able to trade a few products. Firstly is Forex. Secondly, it is CFD. And thirdly, it is precious metals. You are able to trade all this here. Let me give a brief navigation on the basic panels of this trading platform. Okay, so may I direct your attention to this panel here on the left? It is called the Market Watch panel, where you are able to see all the contracts that you are able to trade here. Okay, so in this case, you are seeing all the contracts here because I have chosen to right click and then to show all of the contracts that is available. Okay, so if I hide all, this would be the contracts that I've opened up in charts here. Okay, so to show all, you only have to right click and click show all. So from here you can see all the contracts. Okay, so you would be able to see critical information like the bid price, the ask price, as well as you can add in different columns telling you different information like the daily changes or the spread. Okay, you can do that by right click here again and then to go to columns. So from here, you can feel free to play around to select different kind of options, which would allow you, to see different kind of information that you may find helpful in your trading. Okay, so that is the Market Watch panel. And how else can you view what are the contracts that is available on this trading platform? It is through this button over here. You click on this symbol list, and you are able to see all the contracts that are available here. You see there are Forex, there are CFDs, and there are also shares CFD. And then to look at the individual contract specifications, you can click onto each of them. And I mean, for this presentation purpose, I'll go to the Forex. Okay, so just click onto any of this. You are able to see the contract size here. So this contract size here is 100,000, which means one standard lot lah. Okay, so from here also for each of these contract, you are able to see what is the initial margin. So this is 5%, $5,000. So I think for share CFD, for other kind of contracts, this initial margin would vary lah. So it will be helpful for you to refer to this information before you place a trade. Okay, and then it also shows you information like what are the minimal traded volume, and also what are the swap that you would incur when you place a trade here. Okay, so that is how you can see the wide range of contracts you are able to trade on Phillip MT5. Okay, so right here the navigator panel is where you know what server you are logged on to. So in this case, we are logged on to our server, the Phillip Future server, and this place also houses the indicators and the expert advisors, which are the additional plugins that you can download to use on this trading platform, which I will be covering later on. It's pretty interesting. Okay, and before we proceed, just like to show you how you can start displaying a chart. So I think I like to show you the chart of Euro USD, drag, drop. Okay, so there you go. So for this chart, you can customize them in various ways. So firstly, due to my own preference, I like this chart to be have to have a white background. So from here, you are able to change that through a right click. And I think due to my screen sharing limitation, below here at my cursor, there's this properties. So down here, you click on properties. There's this pop-up window that you can hover over to this colors tab and to change the color scheme. So I prefer color on white. I'd also disable some of the information here for a clearer viewing experience. Okay, so this is it. Okay, and you are able to adjust with the time frame. So day one means a daily chart, H4 means a 4-hourly chart. Depending on your trading horizon, you are able to change that. Okay, so let's look at some of the tools that you can use to perform your technical analysis. Okay, so right here, you can see there are a few tools here, very, very useful tools. So firstly, here you have this crosshair where you can, just hop around any of these points here to see the date and the price at that moment. Okay, and you are also able to measure the movement, the magnitude of the movement. So let's say I want to come down here, this bottom, drag up to the current price, you are able to see the percentage change. So 3.4% right there. So this would be helpful for you, when you're placing trade, you want to determine your risk to reward ratio. You are able to do that through this crosshair. Okay, and in technical analysis, it's a lot about drawing, drawing lines. So let's apply some of the things that we spoke about just now, to look for some of the support and resistance level. Okay, so in this case, I'd like to utilize this drawing tool here to draw a trend line. So a trend, occurs when there is a series of higher highs connecting together. So from here, I can identify two highs here. So one high, two high. I will try to join them together through a trend line. Okay, so this is one example here. I draw a trend line. Okay, so remember what I said. What happens when prices meet a resistance level? So it either conforms to it. So it conforms once, it conforms twice, until it doesn't conform anymore and it breaks out above it. And at times, it would be quite a strong break. As you can see, this huge green candle here. There's a confirmation that it has broken out of this. And also, what happens when prices breaks through this resistance level? Okay, it will look for the next resistance level. So let us see here, what can we identify? If we draw a horizontal line here, yeah, by the way, support and resistance, they can be in the form of, horizontal line, or they can be in a slanted line or a dynamic trend line. Okay, so from here, I think we can identify if we draw a horizontal line here. Yeah, so I'm not sure if you could see here. So this horizontal line that I've drawn here is actually a previous support level. So the prices come down here is a support level, comes down here as a support level until it doesn't hold anymore, it comes down. So whenever the price tries to go back up again, it breaks through this resistance level. It goes up further, it would look for the next resistance level. So you see here, the price reacts nicely just to this line. So upon reaching here, it immediately comes back down. So this is the case that, prices conforms to the resistance level. So I think this is an example, also bringing back the concept of technical analysis. So I personally find it very interesting. So I thought I'd just like to share more on that with you. Okay, so if you dig down further into technical analysis, there are also things like indicators, which you could easily come here to insert. And, there are popular indicators like the RSI. You're able to insert them here. Okay. All right. So that is the chart. I'd like to direct attention down to this toolbox here at the bottom. So this toolbox, it includes important information regarding your trading account. So this first trade tab, it shows you the balance that you have. So this is a demo account. So when you first sign up for a demo account, it would come in a default paper money of $100,000. Okay, so for all the trade that you placed, it would be here. You're able to see what kind of order it is, what size did you trade, the price, okay, and also the stop loss and the take profit levels. And then at the end here, you are able to see if your trades are making money or losing money. So in this case, it is in profit. Okay, so also you are able to look back to history to see the past trades. And then in this terminal itself, you are also able to perform your fundamental analysis by looking at the news here and also looking at the economic calendar here. Okay, so this would take a few seconds to load here. All right, so how do we place a trade here? I think you may be asking. So very simple. There are a few ways that you can do it. So the first way, you could come up here to this new order. You click on it, and then you are able to choose your execution method. It's either by exchange execution or pending order. Okay, you are able to put in the volume that you want to trade, the stop loss and take profit levels. Okay, and also you're able to choose buy or sell here. Okay, so let's place a dummy trade here. So do bear in mind that this is just for demonstration only. It is not any financial advice to buy or sell at this price point. Okay, so let's say we buy here, buy. Okay, so if you have placed the trade here, you would notice that it has come to here lah. Okay, and then you can modify your trade, by placing stop loss or take profit by simply dragging this line over here. So as this is a buy order, if you drag down, it's actually sending a stop loss. Okay, it will prompt you to modify, confirm, you've modified your order. And then if you drag it upwards, it is actually setting a take profit level. Okay, you just click OK, modify, then there you have modified your trade already. Okay, so to close your trade, very simply, just click on this cross here. You are able to close your trade already. Okay, so that is how you place and close a trade. So at this point, I'd like to share with you a very interesting feature that we have, which is downloadable from our website. So if you go to our website, hold on, I would have to change my screen sharing option. Okay, so if you go to our Phillip Nova website, you are able to learn more about these trading tools that I'm going to be covering at this platform. If you scroll down further, there is a list of the trading tools that you can download as a plugin to use in your trading platform. So for today, I'm going to demonstrate to you this Signal Centre by Acuity. Okay, so switching back to my MT5. So once you've downloaded, you can simply launch it by coming to Navigator and Expert Advisors. You drag and drop it. Okay. So at this part, it will take a short moment to launch. Okay, so this is the EA or the extra plugin that you can download for your MT5 platform. So for those of you, who are starting new, you may be, lack of a trading idea. So this is where you come in to get trade ideas that are from credible sources. So the source of these trade signals, they are from Signal Centre by Acuity. They are based in UK and they are regulated by the Financial Conduct Authority of UK. So these are actually trade ideas that are generated by a pool of experienced technical analysts, as well as the combination of some AI technology to generate for you these trade ideas. So if you click into it, you are able to see what the trade idea is all about and what kind of buy order or sell order it is. And then if you want to trade into these trade ideas, simply click on Trade Now. And then the order ticket here will pop up. Okay, if you press place order here, and your pending order would be submitted to MT5. So it is really a one-stop place where you just come in, look at the trade ideas. If you think you want to follow the trade idea, you simply just have to click one button, and then your pending order would appear under this trade panel over here. Okay, so with every trade signal that comes with an expiration date, so it only holds true, like let's say until a certain time is reached. Otherwise, if the price target is not hit, these trade ideas would automatically cancel out, so they wouldn't materialize from there. So I think that is one of the trade idea, one of the trading tools that you're able to explore on Phillip MT5, and I think it'd be really interesting. Okay, so apologies, I think I was going a bit fast because there are a lot of information, and I tried my best to pace it nicely so that you could get sufficient information, as well as not being overloaded with too much information. So I have gone through the basics of the products, like the Forex CFD, gave you an idea on what is the fundamental and technical analysis. I have demonstrated to you the trading platform Phillip MT5 and how you can use it to place a trade, close a trade, and also how you can explore the existing trading tools we have in your trading lah. Okay, so at this point, we have come to the final portion where I will share to you an exclusive perk that you'll be enjoy as an attendee to this webinar. So it is actually an incentive of $50 trading credit when you open an account with this QR code, and you open an account within 3 days, which is 72 hours lah. Okay, so after opening an account through this QR code within 3 days, and if you fund in a minimum capital of $1,000 within a week, you'd be entitled to $50 trading credit. Okay, so this is only applicable for those of you who are attending this live. Okay, so let me repeat myself. You can receive $50 trading credit, firstly, if you scan this QR code and open an account within 3 days, okay, and then fund in $1,000 within a week, and you'd be entitled to this $50 trading credit that will be credited to your trading platform. And if you would like to learn more about this promo, you can go to look at our TNC, which is bit.ly/webinar promo 3105. Okay, you may take a picture of this screen, or can simply take a screenshot of this. I mean, if you are interested to explore further on this portion. Okay, so I think with that, I'd like to thank you very much for your attention throughout this session. We definitely hope that it is of good help. We are really aware that within a 1 hour time frame, it is not sufficient to talk to you like everything about technical analysis or anything about forex trading. So this just serves as a starting for those of you who are interested to start trading lah. And definitely we do have regular trading related webinars that you can find on our Phillip Nova website. So we would also encourage you, just to browse that page through, because sometimes we would dedicate a specific webinar, just to talk about technical analysis. So we would dive really deep into what are candlesticks, patterns, morning star or shooting star, various kind of technical analysis information that it is pretty comprehensive. So we'd also like to hear from you in the feedback form that would come your way after this webinar to let us know what are the webinar that you are interested to hear. So hopefully we would take your feedback and we would see what we can do about it, maybe to cater a separate webinar to talk about the things that you'd be interested to hear. Okay, so I think with that, I'd just like to do a final reminder, scan this QR code and activate within 3 days. fund within a week, and you'll be entitled to a $50 trading credit. And we definitely hope to see you soon in our upcoming webinars. Or if you have any questions, feel free to write into us. We'd be happy to answer them. Okay, so I think I'm just looking at the question from one of our attendees here. So for Phillip Nova customers, do you still have to open an account? Yes, this really depends if you already have an existing Phillip MT5 account. If you do not have, you do need to activate it separately. I think regarding on this, our client relations colleague will reach out to you after this, to give you detailed instruction on exactly how you can do that. Okay, so I think if that is all, once again, thank you very much for attending and your attention. We definitely hope to see you again soon. Okay, thank you. Have a great night, everyone.